Now see the next adjustment, deferred revenue expenditure. There are certain revenue expenditure whose benefit is derived by the business not for 1 year only but for more than 1 year. It lasts maybe for 3 years or maybe for 5 years or 7 years. So expenditure is done, but the benefit of that expenditure, if it is availed by the business for more than 1 year, then that expenditure is called deferred revenue expenditure. For an example, advertisement. Advertisement is a revenue expenditure. Okay, if no information is given, then advertisement is a revenue expenditure. Suppose now for advertisement is, suppose it is rupees 2 lakhs. We have done the expenditure on this head 2 lakhs, but the benefit of this benefit of this expenditure will be for 4 years. We will get the benefit of this expenditure, advertisement expenditure benefit for 4 years. So you divide this 2 lakhs by 4, it means 50,000 advertisement cost is for 1 year. So this will continue for 4 years. So 50,000 will be transferred to PL account debit side, PL account, profit and loss account debit side 50,000, and rest will be shown in the balance sheet. 1,50,000 will be shown in the balance sheet as deferred revenue expenditure. Suppose this expenditure is done, advertisement is done on financial year 2017-18. Okay, 2017-18. In this financial year, this advertisement expenditure is done on the first day. Okay, so this will continue for, you come to the balance sheet, profit and loss account, come to the profit and loss account. In profit and loss account, debit side, this is debit and this is credit side. Balance sheet, this is your liability side and this is your asset side. Is it clear? This is your asset side. Okay. Now so advertisement is 2 lakhs. In this year it is done. Benefit will be derived for 4 years. So 2 lakhs divided by 4. So 50,000 weightage will be given to every year in the statement of PL, in the profit and loss account. So in the debit side, every year in the profit and loss account for the year 2017-18, when you are going to prepare the profit and loss account for 17-18, you write advertisement over here 50,000, and here in the balance sheet you write the deferred advertisement. Deferred advertisement expense, rest amount. From 2 lakhs you have shown 50,000 here, so 1,50,000 will be over here. Balance sheet as at 31st March 2018. Okay, and this is the profit and loss account. Profit and loss account for the year ended 31st. 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 2018. Okay. So in 2018, profit and loss account, debit side to advertisement 50,000, and rest deferred part will be reflected in the balance sheet asset side. In the next financial year 2019, when you prepare the balance sheet, profit and loss account of 2019, and here balance sheet of 2019, then again you write in two advertisement expenses 50,000, and here it will now become 1 lakh. Okay, because 50,000 is you have written off. Now in 2020, when you prepare the profit and loss account for 2020 March, then you write 50,000 over here, and here it will be 50,000. Okay, now 2021, you have to write off advertisement expenses 50,000 here, and from here it is now completely written off. This will not be reflected in the balance sheet. In 4 years, this will be gradually, we will write off these advertisement expenses in 4 years. Okay, so deferred revenue expenditure, actually it's a revenue expenditure, but the benefit of this expenditure continue for more than 1 year. That's why it is gradually write off from the profit and loss account, and the unwritten part, which is not write off, unwritten part will be reflected in the balance sheet asset side till it is finally write off. Is it clear? Till it is finally write off. Suppose the benefit will be for 5 years. Then how much we will write off every year? We will write off every year 40,000. How many years we will write off? We will write off for 5 years. First year 40 in the profit and loss account debit side, first year 40. In balance sheet, first year, profit and loss account 40,000, and in balance sheet asset side we will reflect 1,60,000. Asset side, balance sheet asset side. Okay, profit and loss account which side? Debit side. Second year 40,000 again, here 1,20,000, balance sheet asset side 1,20,000. Third year 40 again, but balance sheet now it will be reduced to 80. Fourth year 40, here it is 40, reduced by 40. Fifth year 40, and thereafter this will not be reflected in the balance sheet. So in 5 years I have written off this advertisement. That's why this advertisement is called deferred revenue expenditure, deferred advertisement. Okay, now coming to the next adjustment related to manager's commission. If in the adjustment it has given that you provide the manager's commission, then you have to see the manager's commission will be provided on which amount. If the manager's commission will be provided on the net profit before charging such commission, or manager's commission will be provided on net profit after charging such commissions. You know that when the manager, we are going to allow the commission to manager, the entry will be commission account debit, manager's commission account debit. We are not going to write the manager, commission account debit to outstanding manager commission, outstanding commission account debit to outstanding commission account debit to outstanding commission account. This is the adjustment entry for the manager's commission. So commission account debit to outstanding commission, or you may write the manager's commission account debit to outstanding manager commission. You may write it. Okay. So commission account debit, because it's an expense, commission account debit to outstanding commissions. So manager's commission, you see the manager's commission is given on which amount? Suppose manager's commission is given on net profit before charging such commission, and suppose the net profit is net profit before commission to manager is rupees 33,000. Suppose the net profit before commission to manager is 33,000. Is it clear? It is 33,000. Then the manager's commission will be 33,000 into, and the rate of commission, suppose rate of commission is 10%. Rate of commission is manager's commission on net profit is at the rate of 10% So 10% of 33,000, so it is 3,300. This is the manager commission. If it is before charging, so net profit before charging manager commission, if it is 33,000, simply you calculate 10% of 33,000. But if the commission is on net profit after charging manager's commission, after charging manager's commission, then this will be calculated 33,000 into 10 upon 100 10. So this will be 3,000 manager's commissions. Outstanding manager's commission will be 3,000. Okay. If it is after charging, after giving commission to the manager, then you calculate the net profit, and on that net profit you calculate the commission. Suppose after charging manager's commission, the profit is 100. Then the commission will be how much? Commission will be 10. So when you add it, then it is what? Net profit before commission. So you find it like this. If the net profit before commission is 10, then commission is how much? Commission is 10 rupees. Same thing is applied over here. 33,000 is the net profit before commission, then the commission will be 10 upon 110. So the journal entry will be, adjustment entry will be commission account debit to outstanding commission. On that time you must see that the manager's commission on net profit is given before or after. If it is before, then see the net profit before commission is how much, and then directly you calculate the percentage 10 upon 100. And if it is after, then 10 upon 110. Okay. And this outstanding commission will be reflected in the liability side of the balance sheet, and this commission will be shown in the debit side of profit and loss account. This commission will be in the debit side of profit and loss account, and this outstanding commission will be in the liability side of the balance sheet, depending upon the way you are calculating. It may be 33 or it may be 3,000, 33 or 3,000. Now the next adjustment is related to capital expenditure sometime is wrongly treated as revenue expenditure. Sometimes the capital expenditure wrongly treated as revenue expenditure. This type of errors is committed by the accountant while preparing the or maintaining the books of account. Then what we'll do and how we'll do the treatment at the time of preparing financial statement. What adjustment we will do. For example, wages paid on installation of machinery wrongly debited to wages account by the accountant. Similarly, material purchased for the construction of building wrongly debited to purchase account. Amount spent on erection of a cycle shed were wrongly debited to repairs account. So what we'll do, how we'll do the adjustment if such mistake is committed by the accountant while recording the transactions. So sometimes what happened that the capital expenditure is wrongly treated as a revenue expenditure. Come to the number 1. Wages paid on installation of machinery wrongly debited to wages account. Then what we'll do, the wrong entry, what the wrong entry the accountant has done, you know it, wages account debit to cash account, he has done it. Okay, this is the entry what the accountant has done. However, the right entry should be machinery to cash. Machinery to cash, this should be the right entry. Machinery to cash. Now rectifying entry, or you can say the adjusting entry will be machinery account debit to wages account. This is the adjusting entry we have to pass. This adjusting entry we have to pass. While preparing the financial statement, this adjusting entry we have to pass, machinery account debit to wages account. So in trading account we will deduct it from the wages, and in balance sheet we will add on machinery. So machinery will be increased and the wages will be decreased by that amount. So treatment will be in trading account, debit side when we write the wages, from that wages you deduct this one, and in machinery account, asset side when you are going to write the machinery, you add the value, this one you have to add it. So in machinery we will add and from wages we will deduct. Now come to the next one. Material purchased for the construction of building were wrongly debited to purchase account. The wrong entry done by the accountant is purchase account debit to cash account. This is the wrong entry what the accountant has done. The right entry should be building account debit to cash account. Building to cash. Okay. Now adjusting entry, I am talking about the adjusting entry. What adjusting entry we will do? So building account will be debited, and purchase will be cancelled. So purchase account will be credited, purchase will be cancelled. This is the adjusting entry. Building account will be at right place and purchase will be cancelled. So while preparing the financial statement, from purchase we will deduct this amount. From purchase in trading account debit side, from purchase we will deduct it, and in balance sheet we add on building. Now here third, amount spent on the erections of cycle shed were wrongly debited to repairs account. Cycle shed means building account debit to, so wrong entry passed by the accountant is repairs to cash. This is the wrong entry they have passed, wrong. Right should be cycle shed or building account debit to cash account, building account debit to cash account. This is the right entry but not done. So the adjusting entry will be building will be at right place, building account will be debited, and repairs will be cancelled. So while preparing the financial statement, in balance sheet you add on building, the amount you add on building, and in profit and loss account, when you are going to write the repairs, you deduct the amount of these repairs from the repairs which is given in the trial balance. That repairs which is given in the trial balance, from that amount, this repair amount will be deducted in the profit and loss account debit side. Is it clear? Now see the next adjustment. Goods sold and dispatched but omitted to be recorded in the books. Forget to record in the books. It's an error of complete omission. So while preparing the financial statement, we will record these transactions. So transaction will be goods sold and dispatched but omitted to be recorded. So sundry debtors account debit or customer account debit to sales account, This will be the entry, sundry debtors account debit to sales account. So in trading account, credit side, by sales which is given in the trial balance, you write it over here and add this one, omitted, you add it and write the amount in the outer column. Add this one. Suppose here it is omitted, 20,000 is omitted, goods sold and dispatched but omitted to be recorded. Suppose the amount is 20,000. So debtors account debit to sales account. Sales will increase by 20,000. You have added 20,000 over here. You have to write the sales figure which is given in the trial balance and then write it the final amount in the outer column. In balance sheet, asset side, this is your asset side, okay. What we will do in the asset side, sundry debtors which is given and add omitted, you add it and write the amount in the outer column. How much is omitted? 20,000 is omitted. You write the amount in the outer column. So in the two places we will do the adjustment. One, in the credit side of trading account, you add this value in the sales. You have to increase the sales amount, and in the asset side balance sheet you have to increase the debtors amount. Debtor amount will be increased by the same 20,000, by the same amount, okay. So sales will be increased in trading account and the debtors will be increased in the balance sheet assets side. The next adjustment is goods purchased and included in stock, but omitted to be record, means forget to record, goods purchased, taken into stock but omitted to record in the books. It's an error of complete omission. This information, this comes to you when the trial balance is prepared, means in the additional information. Then you pass one adjusting entry of error of complete omission. Purchase account debit to creditors account, to sundry creditors account, means suppliers account. Suppose it is 15,000, okay. In trial balance, suppose in the trial balance, purchase given over here is, purchase is 2 lakhs and creditors is sundry creditors is 40,000 is the sundry creditors which is given in the trial balance. And in additional information you comes to know that the goods which was purchased, taken into stock but omitted to record in the books, omitted to record, then you pass this entry in your adjustment entry, purchase account debit to creditors account. Now how we will do the treatment in the while preparing the financial statement? Purchase is reflected in the trading account. Which side? Purchase will be reflected in the trading account. Which side? Debit side. Trading account debit side. Okay, this is your debit side. So debit side you write the purchase to purchase which is given in the trial balance. In the trial balance it has given 2 lakhs and then you add omitted to record this one 15,000. So in outer column you write 2,15,000 in the trading account, and in balance sheet liability side, this is your liability side, and that side is your asset side. And you know that the creditors reflect which side? Liability side. Sundry creditors in the liability side. Sundry creditors is how much in the trial balance? It is 40,000. Write it, and you add omitted. This one you add it in the creditors. This creditor which was omitted earlier, you add it, and now your new creditor after addition is 55,000. So the adjustment will be at 2 places. In trading account debit side you add on purchase which was omitted earlier, and on the same time in the balance sheet in sundry creditors you add that amount to know the actual creditors as on that date. Okay, actual creditors as on that date. So this adjustment is related to what? Goods purchased and included in stock but omitted to be recorded in the books of account. This is related to error of complete omission, and these errors come to your knowledge after preparation of trial balance. This is given in the adjustment. Next adjustment related to sale of goods on approval basis, but that is recorded by the accountant as actual sales. When we sell the goods on approval basis, after giving approval by the customer, then that will be treated as actual sales. So if the approval is not yet received by us, that will not be treated by us as actual sales. But what the accountant has done, when the goods is given to the customer on approval basis, sale or return basis, approval basis, but our accountant has recorded in the books as actual sales. This is the mistake the accountant has committed. So what we'll do when we prepare the financial statement, this should not be treated as a sales, but the accountant has treated as a sales. So what we'll do, we'll reverse that entry first. Sales account will be debited. Sales will be debited because the accountant has done the credit the sales account. So we will reverse it, and sundry debtors will be credited. Sundry debtors account will be credited. We have to do the reverse treatment. Suppose sale of goods on approval basis, okay, goods sold, sale of goods on approval basis, suppose it is 50,000 sold goods on approval basis is of rupees 50,000. Cost of that goods is 45,000. Cost of that goods is 45,000. Sold goods or given goods to the customer on approval basis of rupees 50,000 and cost of that goods is 45,000, for example. Okay, this is the transaction. So you have to do the reverse entry. Sales account will be debited by 50 and debtors will be credited by 50. You have to cancel the previous one first. So in trading account, while we prepare the trading account, credit side, trading account which side? Credit side of the trading account, this side. Suppose trial balance, in the trial balance, sales is 2,50,000. Okay, sundry debtors is 4 lakhs. Is the sundry debtors is 1 lakh. Okay, now what we will do? Credit side you write the by sales which is given in the trial balance. How much? 2,50,000, and you deduct this sales from that. You write it less approval basis, approval basis 50,000. You deduct it and write the amount in the outer column 2 lakhs. Okay, this will be done. This you do it in the trading account. In balance sheet, and one more thing, in the closing stock, you write the closing stock over here. Closing stock. Suppose closing stock given in the adjustment is closing stock in the adjustment is, suppose it is 70,000 given. So you write the closing stock over here, closing stock, $70,000, this one, and add this one, approval basis. But here you add cost or market price, whichever is less. Sold goods on approval basis for rupees 50,000. For rupees 50,000, cost price of that goods is 45. So you take it cost price, cost or market value, whichever is less, and then you write the amount in the outer column, 1,15,000. Cost or market price, whichever is less, will be taken for the stock calculations. So 70,000 is the closing stock given in the adjustment, this 70,000, and plus this entry when we have passed. So our closing stock will increase by 45, so 1,15,000. And in balance sheet, what we will do, in the asset side, this side, asset side, balance sheet, asset side. This is your liability side. This side is your liability side. I am talking about asset side. Okay, asset side. Sundry debtors given is how much? 1 lakh is the sundry debtor given in the trial balance. You just deduct the approval basis. This one, because debtors I have credited over here. I have cancelled the debtors by 50,000. So deduct it. So rest will be reflected in the outer column, and here closing stock This amount we will write in the balance sheet as well, 1,15,000. 1,15,000, this amount we will write in the balance sheet as well. Closing stock, not closing stock, this amount. After adding the approval basis of that, we will write the 1,15,000 in the balance sheet asset side. So debtors will be deducted by this amount because debtors will be reduced because it is for approval. It is not considered, this should not be considered as a actual sales. So debtor will be reduced, sales will be reduced, and closing stock will be increased by the amount of whichever is less. So cost is less, so by that amount the closing stock will increase. This will be the treatment when the goods is sent for approval basis to the customer. Without receiving the approval from their ends, we can't treat that as actual sales. If the accountant has treated without approval as actual sales, then we have to do the necessary corrections or pass the adjustment entries, sales account debit to sundry debtors, and accordingly this impact will be in the financial statement. In sales, the figure will be reduced by that amount, closing stock will increase, debtors will decrease, and closing stock will increase. Okay.